So Rob, welcome back. Been maybe a month or so. It's time to talk about the market and what's going on.
Always good to be back.
And welcome to fun October.
Mm-hmm.
You know, historically, Octobers have been all over the place.
Yes,
There've
they
been
have.
some great months of October.
Same with September too.
Same with September. They almost rhyme.
Right, correct.
Right, yep. But October, it can be a little ghoulish at times.
Yep.
Right.
No pun intended.
Yeah, none. You know, take it how you wish. Bouncing around. We've had some volatility. You know, there are interest rate predictions. You know, everyone trying to figure out what's going to happen there. We have geopolitical tensions between the U.S. and China and tariffs. The T word's back.
There's certainly a lot going on.
You know, we've got earnings coming out right now. Some of it's positive, a good portion, but there's always concerns in there.
Correct.
Right. So where do we want to start on this? Why is the market bouncing around?
That's a good question, and I almost don't even know where to start with it. I think it wouldn't surprise me if markets keep bouncing a little bit because there's a lot of conflicting information out there. I don't know how many new highs we've hit.
And that's hour by hour.
Yeah, right.
Right.
Yeah, markets have hit, I don't know how many new highs this year. No, a lot, let's put it that way. But when you look at some of the underlying data, it seems to be going the other way. So people are kind of shaking their heads thinking, well, if we went based on what we learned in economics class, like we should have been in a recession 8 times over by now, and this bull market should be long gone. But it's not. So you have a lot of people fumbling around and trying to find the answer, well, what's the disconnect? And I know you and I have some ideas about what that disconnect could be.
You're exactly right. Economics, everything we took in school, toss it out the door.
Yep.
Right. And, you know, it's hard to make sense of what is supposed to make sense when we're bouncing.
I know what we try to do here is we to maybe try to paint a picture for our clients. We start with certain data points that we, for the most part, know that are true. So where are we broadly? The S&P 500 is richly valued, has been for a while, close to 24 times next year's earnings, which what does that mean? What I like to tell people is it most likely means we're not going to get these massive multiple expansion years anymore, where I think a plus 20 or 30 year in the S&P 500 is looking a little less likely. So what this means is future market movements are going to be based on earnings, and earnings are cutting both ways, kind of more to follow there. So we know the market's expensive. Some earnings are holding up. Let's talk more about other earnings in a little bit, but then what's the flip side of the coin? We know that price levels are up. There's tariff noise out there, which we're still trying to figure out how that's going to shake through the entire economy, and then how consumers are going to react to it. And then with the level of interest rates, people are pricing in more cuts. No one actually knows what's going to happen. But then you also have the other side of the Phillips curve, which is unemployment. And the headline unemployment is looking fine. But what you're seeing once you kind of push back the curtains is maybe it's a little bit shakier. When you look at the U6 unemployment metric, which we're dusting off our post-GFC playbook here, I'm finally starting to earn some of the gray hair that I'm dealing with now.
Yeah.
What that is it's an employment metric that actually looks at not the amount of people looking for work, but also looks at the amount of people that aren't looking for work, or discouraged, or maybe underemployed, so a bigger supply base. And that is dramatically higher. That's at 8% as opposed to 4%, which is the headline rate.
So it's a little broader.
It's broader,
right?
And it's definitely ticking up. So pre-COVID, it was around 6.5, and now it's above 8. So I do think that leads to a shakier market. So all these things combined should probably lead to a shakier market, but it hasn't.
And I think one other, piece that we see in the headlines a lot right now also is just, is there an AI bubble?
Yeah.
Right. You flip on the news, any financial network, and I feel like a little bit they're grasping at straws a little bit, trying to figure out, okay, is there one? They want to keep the viewers, and so, hey, is this a 2000? Are we going to go back to a tech bubble that we had 25 years ago?
It's a great question, and there's a lot to unpack there, and I'm glad you brought it up. A lot of people are trying to connect the dot-com bubble that I know that you still remember quite well at the beginning of your career. And what you saw there was inflated valuations across the board with companies that aren't making money, which isn't necessarily true today. And you keep hearing the refrain from financial pundits that earnings are there, cash flows are there. We're not going to see this big .com like bubble. I think there's another side of the story that we need to take a look at. If you look at what AI is today, ChatGPT, XAI, they aren't making money. In fact, this is a vastly money-losing proposition. And the companies that are funding them are well-capitalized when you look at Microsoft and NVIDIA, and they're throwing hundreds of billions of dollars at companies like ChatGPT and XAI. So it's masking a lot of things. So we know that the companies that we think of as developing AI and large language models, they aren't making money, but they aren't public, so we're ignoring those. But with Microsoft and NVIDIA just plowing hundreds of billions in, what does that actually do? So free cash flow is down. So maybe their valuations, if you were to do a discounted cash flow, which probably isn't applicable to those companies anymore, isn't looking so good.
Free cash flow for the Microsofts and NVIDIAs
Correct.
of the world,
Yes.
right? So they're using that excess cash flow to dump over here into future investment. So now
Yes.
we're going to talk about what's the outcome of that.
And no one knows. And furthermore, even when you get on the other side of all that CapEx, they got to depreciate it. So then maybe earnings go down too. So people are getting a little fearful where, yes, you have these very high valuations, which from a fundamental perspective maybe shouldn't hold up, but we know that markets are forward-looking anyway. So you brought up a good point. What's the end result of all this capital spending? And I'm going to be perfectly honest with you. No one really knows.
That's right.
And when you look at what AI is today, it's just mapping the statistical probability of what word comes next. And what I like to say to people is you type into something into ChatGPT, yeah, it knows, but it doesn't quite understand. And in fact, the example that I heard the other day is if you were to ask ChatGPT to develop a cartoon of 1,000 horses jumping over a fence, well, some of those horses are going to look a little funny, right? Because engineers haven't gotten to a layer to kind of cover up the discrepancies in your ask.
Yeah.
And what I think the reason why people are pumping hundreds of billions, if not trillions, into this space is, will this, what we currently have now, make this leap into generative AI, with artificial general intelligence, which is supposed to be much more human-like? And I think that's probably a bit more far-fetched.
We're a little further out, from that, right? And yeah, when we go back here and look, when I was first, I remember having a lot of conversations in the 90s with people talking about AOL and Yahoo, were big ones back then, really popular names. Those stocks were just absolutely taking off, but they had no earnings, really not much cash flow. There wasn't much there. There wasn't a lot of substance. It was just this excitement, this exuberance, right? And to your point, the NVIDIAs of the world, Meta, Microsoft, they are well funded. They have more money than what they need, than what they know what to do with.
Which is why they're
and that's
pumping
a
it
little bit of a problem,
yes, exactly.
potentially, right? And so they're throwing it at AI, hoping for a better outcome here in the long run.
It's definitely a bit of an arms race. And they definitely think that the risk is not spending enough money on it.
Right.
Ultimately, I think you're going to have some other technology come out there to make that leap. We'll see what happens. I think the other thing that's really giving people a little bit of a pause is the circular nature of these finances. So you'll read headlines where CoreWeave or Open AI is buying, I don't know how many thousands of chips that aren't cheap, right, from NVIDIA. But then when you look at how much revenue OpenAI is bringing in, it's only $13 billion. So then NVIDIA is pumping $100 billion into OpenAI as an investment. So it kind of becomes, where is this cash flow going, and is it actually revenue? And then some rumors of chips being leased back. That just has a lot of people not quite understanding where all the money is going.
And when you start drawing out where the money's going, a lot of it's kind of going in a circle. It's going from one company to another. It's just being circulated around.
And essentially what we're coming to is, outside of a couple of companies, the only way this AI race is going to keep going is through fundraising. We just hope that the spigot stays open and people keep throwing billions at this. But as you and I well know, spigots don't stay open forever. So if that spigot gets closed, that means there's less funding going to OpenAI, maybe NVIDIA can't raise as much. I don't know. Weird example there. But the point is if money gets shut off, that means that maybe these companies that have powered this rally are going to falter a little bit. And because they have so much concentration in all of the major indices, if those companies fall, the entire index is going to fall too.
Yeah.
So that's what has people on edge.
Something we'll get into here in just a moment is let's say there is a pullback at some point, or maybe even a stumble or a fall, right? What do you do at that point? And we'll get into that, I think, here in just a moment. What are some other things that we're seeing that that's causing maybe good or bad here coming up? We have earnings, right, starting to come out here. We have bank earnings this week,
which were really good. Banks reported phenomenal earnings, and a lot of that, I think people need to look at the fact that these are major Wall Street institutions. So their core revenue streams aren't just direct lending to consumers and small businesses. They take into account investment banking, M&A, trading. And as we know, markets have been relatively good. IPO markets have opened up. You've seen some more M&A. So they're reporting everything's being fine. What I think is going to be more interesting is what regional banks are going to start reporting and what they say. I think another sector that needs to be looked at in terms of consumer health, when you look at fast casual and quick serve restaurants, most families, if they're starting to feel a little bit of pain, start pulling back there quite a bit. And I can tell you that Domino's reported earnings, and they crushed it. They're probably stealing market share. But a common refrain for that management over the past couple of quarters has been a shaky consumer. So that's something that I would take a hard look at is what are those other quick serve restaurants saying?
A big one that I've always watched over the years is Chipotle.
Yeah.
You can spend, it used to be $5 for a giant burrito. You could break that up into a couple meals. Now it's certainly increased. Inflation has hit that. It's probably 10, I don't know what it is, but I know it's a lot more. But Chipotle is one that I've always watched, going all the way back to '08 and what happened there. I think that's an area where I always saw the consumer spending to buy that big burrito because you could kind of break it up into two meals almost. Sure. And I always looked at it as maybe a buying opportunity at times. Not that we're choosing or endorsing a stock or something, but I always looked at it as kind of a bellwether stock out there to keep my eye on. Absolutely. And see how the consumer's reacting.
Walmart, Dollar General, same situation. And I don't know when it's going to become clear, but the question that everyone wants answered is, okay, despite some of the economic softening that we're seeing, GDP is still up. Why is that? Is that spending on AI and maybe some boomer spend and some wealthy family spend? Will that prop up the entire economy, or are we going to start seeing some bigger softness? And the other thing that has people on edge is now all of a sudden you have a good chunk of the workforce not receiving a paycheck.
Yeah. Another little piece I'd like to hit on here for a second is just algorithmic trading, short-term speculation. That can amplify those moves in the market at times. And I think along with that is investor psychology, that fear and greed within those little bumps and, where we see the market go one way during the day and, something we can't control, which is some of that trading that happens throughout the day maybe pushes it a little further, or some of that investor psychology, fear and greed also pushes it. So those are factors too, always to be aware of.
Yeah, I would agree with that quite a bit. And I mean, you see it, whether it's a tweet or something else that's crossing everyone's, laptop, markets will move on it. And I think we'll see a lot more of that going forward. Underpinning that, I think, switching gears just a tiny bit, as long as passive fund flows are positive, and there are a lot of researchers and a lot of fund managers that know a lot more about this than I do, but as long as we're all contributing to our 401k, the path of least resistance tends to be up. But yes, you will have these shocks intraday, and depending on how on edge people they could be exacerbated.
Yeah. For those long-term investors, I think volatility is not a signal to run, right, or have fear. It's really an opportunity a lot of times, right? If we go back to March, April earlier this year, tariffs were in the headlines at that point, right? every second. Three primary things that we mostly did with our clients. We looked at rebalancing.
Yep.
We looked at buying areas that were oversold, that
Sure.
were opportunistic. We looked at doing Roth conversions, because when you do that conversion, you can convert a greater percentage of that overall portfolio.
Yep.
Right? A lot of great things in there, a lot of great opportunities to take advantage of.
Yes.
And so a long-term investor looks at this, I think, as being an opportunity versus, oh no, run for the hills.
Yes, I would agree with that. In fact, there is never not an opportunity in markets. At least I believe so. I mean, so what does this mean to our clients? I think you're never going to get us or an EdgeRock advisor saying you can't own the S&P 500 or the Qs. No, they've been a fantastic growth engine, and we can refer to the chart over the last 20, 30, 40 years. It's been a phenomenal story, and long term, I don't think that's necessarily going to change, but it's just how can you diversify and put some bets that maybe aren't as in tune with the big public indexes that we're used to watching on CNBC and Bloomberg. And there are areas of investment that you and I both really, really like.
Getting ready to ask that. What are some specific sectors that we find compelling right now?
The story that we're hearing behind real estate, they've kind of already gone through a little bit of a recession with interest rates popping up, valuations are depressed, less activity, less lending going on in the area. And with interest rates easing a little bit, we expect those aspects to flip a little bit. So it's kind of the old adage of, well, you're kind of buying low, so maybe you're being compensated to take some of that risk. And let's be honest, not all real estate is, B-rated office.
We have multifamily, we have industrial, we have office, right? B-rated office.
Yep.
And then there's A-rated office also, right? Which here in the Denver area in the Tech Center in Cherry Creek is in high demand.
Yep, correct.
Right? So there are areas, again, going back just to what I said a moment ago, this is about being opportunistic, looking for areas to take advantage of, right? And being a little bit of a contrarian to the headlines.
Correct.
There, right?
And of course, you and I have talked about this before. I think the international story is still there. A lot of that is with a little bit of the dollar weakness, which the dollar strengthens and weakens over time. I don't think what we're seeing here is necessarily anything new, but what you and I think our firm here has been conveying to clients is, unlike maybe the past 5, 6, 7, 10 years where, let's face it was kind of the S&P 500 or bust, we might be going into a regime where a little bit more diversification is not going to hurt you at all. In fact, it could actually be your friend.
It can really, over time, smooth out those returns where we don't have, again, quite the roller coaster.
Exactly.
At some point, the Qs will pull back, or the S&P and so forth. So when we're talking about private investments, we're looking at private equity, private credit, infrastructure, which that's an area that we really like and has been really nice the last couple of years. Real estate. So when we're looking at that, what are maybe a couple of misconceptions that people have about private investments, maybe along liquidity or risk, or just what they read and hear on a daily basis?
It's a good question, and you can look at it from a couple different angles. I think a lot of individuals and families are a little hesitant to quote unquote lock their money up, which I could understand. And my retort is, well, if you're not willing to place your money there for a while, it's not necessarily an investment. It's more of a trade and speculation, which EdgeRock doesn't do anyway. Also, with the advent of interval funds that do and can offer, well, they have to offer liquidity, but they do offer liquidity quarterly, I think helps that a little bit, even though we try to tell people we're not necessarily trading these instruments. These are strategies for the long haul.
It's much more consumer friendly than what it was years ago, because they've built in some liquidity provisions here where on a quarterly basis, and you might have the opportunity to pull some money if we need to or want to, right?
Correct.
So it's more consumer friendly for the everyday family that we work with.
Correct. Not to say that there aren't places for more traditional drawdown strategies here or there. The other, if we were to talk about misconceptions, you harp on this all the time. It's just your disparity in returns, and that your sponsor or business that is running this investment strategy for you really, really matters, because you're top level returns are going to differ dramatically from your bottom level returns. So you might as well go with your A players.
Yeah.
So just because something's private doesn't necessarily mean it's good, which just kind of gets back to everyone thinking markets are oversaturated on that end. I don't think they are. In fact, I don't think they've changed. Yes, you have a lot of newer private credit strategies, and I understand a lot of money is flowing into the space, but your best underwriters last year are most likely still going to be your best underwriters this year. So you might as well just keep going with them.
What you just said, I can't emphasize enough. I think, where...
Because I've heard it a lot.
Right. Yeah. And so many families, when we're talking one-on-one, and, it's easy to go out, think about just headlines that, hey, beware of private credit, beware of private equity. Well, it's not all the same. Just like, if I were to look at every car in a parking lot, it's not all the same, right? No. And what we want to attempt to do here in the private equity, credit, infrastructure, real estate side with all that is find the best in class. Mm-hmm. And how do we go about determining best in class a lot of times? And you can really speak to this, is the track record of the money manager. Correct. Right? I want to see a long track record, a good track record. I'm hiring a team. I want that team on my side.
Well, you said it right there, team. That's the number one thing that we look at is the overall team, the experience. Make sure there are no major level departures. Make sure there's no huge key man risk. And then making sure that team is well incentivized, and those incentivized are aligned with their investors. It's boring, it's simple, but it works.
It does.
And that's not to say, right, you've seen this quite a bit. Credit cycles are credit cycles. We will always have frothy markets, and we could come into a more recessionary environment where default rates tick up. But again, going back to analyzing who's underwriting the debt, your best underwriters, even in adverse environments, are going to have a great track record.
That's right. And usually better track record than the markets.
That's right.
And over time, the purpose of any investment, it's outpace inflation over the long run.
That's right.
Much easier said than done.
Yep.
Right. So at the end of the day, when we're looking at volatility, that's not what destroys or hurts someone's portfolio or wealth. It's poor decisions during those volatile times.
Correct.
Right. And being reactionary, mm-hmm. being emotional, versus having a plan.
Yep.
And a well-diversified, thought-out allocation.
Correct. And then just kind of sticking with your own allocation guidelines.
Yeah.
As you mentioned earlier, any drawdown is going to bring about opportunities, and you really have to take an objective look back and say, well, what can I do to improve my returns going forward? And very rarely is it going to be, I'm going to sell everything, or I am going to go completely into bonds. No, it's... Let's relax. What do we maybe not like in this environment that we could reduce? But then what's an opportunity that I can go in and maybe get a better risk-adjusted return? That's all.
Yeah. The approach or the question or the thought that I see a lot of families have is, how do I get a X rate of return? Yeah. Or how do I hit a home run? And I love Charlie Munger's problem solving and his approach to how he did things during his career. And one of the most important things I think he applied to a lot of problems or situations, things that he was trying to solve, was the inverse.
Oh, yeah, sure.
It's not about, I think oftentimes we ask ourselves a poor question or we have a poor statement. It's not about how can I get this great rate of return, or how do I hit this home run? It's, let's inverse that. How do I avoid a significant loss?
Framing.
Right?
Yep.
Exactly. Let's think better. Let's ask ourselves a better question here. And that oftentimes leads us to a better decision and a better outcome.
Yeah, I think a big misconception amongst the general consumer is that great investors or even great traders are right all the time. Nothing could be further from the truth. And in fact, your best traders are batting over 500, and they call that a career and do great. And then the same thing with your best investors. Not everything is going to work out, and yeah, you're going to step in mud every once in a while, but it's really using your experience to know what step is most likely to be muddy versus another step.
Right. It's not about trying to, that was a great step. It's avoiding the bad step.
Yeah.
That is actually more important.
Yeah, and I think what you and I are trying to tell people is maybe risk is going to matter more over the next 5 or 6 years than they did the last 5 or 6 years outside
mm-hmm.
of COVID.
Yeah,
I think that's it. And we've seen cycles where diversification works, and we've seen cycles where you've arguably hadn't you don't need as much.
Any other important points we want to hit on, that come to mind, headlines or, key factors that are out there?
I think we hit on a lot in a relatively short amount of time.
Yeah.
I would just reiterate that markets are always uncertain. A lot of the economic data out there kind of cut both ways, and it's hard to pick out facts versus noise. But I would say just because things are looking increasingly uncertain, it's not necessarily a time, or there's not a need to panic, at least not yet.
No. It's easy to get caught up in that noise, the headlines, talking heads, constant stream of data that's out there. Over my career of 30 plus years, there's always, the market is always bouncing around, right? But the reason that it's bouncing around always changes.
Correct. Yeah.
But the market markets, right? It continues to march on.
Yes.
Over time, it's done well. The truth is, I think, that long-term approach isn't about reacting fast. It's about designing a smart allocation.
Correct.
And when you've done that, you can take advantage of things and be opportunistic. And I think right now it's just let's keep our eyes maybe just a little bit more peeled than normal.
Yeah.
Just with some of the things that are out there, some of the headlines, right?
Just there's more uncertainty.
Yeah, a little more uncertainty. So we don't try to make forecasts. We don't chase fads. It's about designing the right allocation to be opportunistic and to outlast these times and take advantage of rebalancing, buying things that have been oversold whenever that happens, maybe looking at Roth conversions, doing some tax planning. Yep. And I tell people all the time, I don't know what the market's going to do tomorrow. And if anyone tells you that, I wouldn't listen to them. But as the market moves along, maybe the best rate of return you can make between now and the end of the year here in the fourth quarter is doing some tax planning. Mm-hmm. It's completely change of gears. But, once December 31st hits, a lot of times that cuts off the valve and there's nothing else you can do about 2025, but there might be some great opportunities there. I was talking to a doctor actually at dinner last night, and he happens to be a 1099. He works for a hospital, but on the side, He actually does some surgical work.
Yep.
And he's a 1099. He's like, man, taxes are killing me with my 1099 because I have no deductions. There actually are probably a lot of opportunities there. It's just that he's so busy as a surgeon, doesn't have time to figure that out. Unfortunately, most CPAs are great historians. They're just going to take a look at your return and fill things in versus looking forward to figure out how can we reduce your tax. So I said, hey, let's get together next week. Let's look at opportunities. There probably are some things we can do to reduce that tax at the end of the year. Yep. That might be the best way to help preserve some of that rate of return or maybe put some more money in your pocket.
It's certainly the more sure way to put cash directly back in your pocket. Yeah. So tax planning, tax loss harvesting, something that we did earlier this week. I think that will always make a difference for our clients. Yeah,
maybe something we could do here in the next time we're together is to talk about opportunities for tax loss harvesting.
Sure.
And maybe a quick little teaser on that end.
Yeah.
We look at it, there are approximately 243 trading days throughout the year, right?
Right.
And a good advisor does tax loss harvesting usually just one day per year.
And unfortunately, it's usually closer to the end of the year, which I'm not going to say that it's nothing, because it's not. Any tax loss harvesting is worthwhile, but it's more effective just to do it, to frequently check accounts and do it across the entire year, especially when you do get some volatility like we did earlier this week. But then again, when you look at what happened in April, might as well take advantage of it.
Exactly. And I know you did some tax loss harvesting for our clients this week, and we're not asleep at the wheel. It's not on cruise control.
No.
Eyes wide awake.
It's kind of hard not to pay attention to everything.
Yeah. Awesome. Rob, it's been great.
It's been fun.
Looking forward to next time.
Yeah,
we'll
absolutely.
hit on some tax loss harvesting, probably some other great areas. And until then, back at it. Make sure we have a great, for everyone listening, it's all about the right allocation, having a plan and sticking to that plan.
Yep. So, yeah, absolutely. Looking forward to next time.
Awesome. Thanks, Rob.
Yeah, thanks, Kyle.